The Horizons S&P/TSX 60 Index ETF, or HXT, is a popular Canadian exchange-traded fund that tracks the performance of the S&P/TSX 60 Index. This index represents 60 of the largest and most established companies in Canada, spanning sectors like energy, financials, materials, and technology. By investing in HXT, you gain exposure to a broad range of leading Canadian companies with a single, simple investment. How does HXT work? HXT uses a strategy called total return swaps to replicate the performance of the S&P/TSX 60 index. Instead of directly buying the stocks in the index, HXT enters into agreements with financial institutions to match the returns of the index. This structure helps reduce costs and provides certain tax advantages for investors. What makes HXT unique is its focus on being cost-efficient. The fund has one of the lowest management fees in Canada, with a management expense ratio, MER, of just 0.03%. This means more of your money stays invested and has the potential to grow, rather than being eaten up by fees. Why choose HXT? HXT is designed for investors who want long-term growth and broad exposure to the Canadian stock market without actively managing a portfolio. Since it tracks the S&P/TSX 60 index, it includes large, stable companies like Royal Bank of Canada, Shopify, Enbridge, and Suncor Energy. These companies represent a significant portion of Canada's economy, making HXT an easy way to invest in the overall performance of the Canadian market. Example of investing in HXT. Let's say you have $1,000 to invest, and you decide to put it into HXT. Over time, as the value of the S&P/TSX 60 index rises, so does the value of HXT. For instance, if the index grows by 10% in a year, your investment in HXT would also grow by approximately 10%, minus the small 0.03% fee. If the index falls, your investment in HXT would decrease by the same amount. This makes HXT a great choice for those who want a simple, low-cost way to mirror the performance of the Canadian stock market without picking individual stocks. Benefits of HXT. Low fees. With an MER of only 0.03%, HXT is one of the cheapest ways to invest in the Canadian market. Lower fees mean you keep more of your returns over time. Diversification. HXT gives you exposure to 60 of Canada's largest companies across multiple sectors, reducing the risk that comes with investing in a single stock. Tax efficiency. HXT's total return swap structure means it doesn't pay out dividends directly. Instead, dividends are reinvested within the fund, which can be beneficial for investors in non-registered accounts because it delays taxable income. Simplicity. HXT is easy to buy and sell on the Toronto Stock Exchange, making it accessible for investors using regular brokerage accounts. Risks of HXT. While HXT has many advantages, there are also some risks to consider. Market risk. Since HXT tracks the S&P/TSX 60 index, its performance depends on the overall performance of the Canadian stock market. If the market drops, so does the value of HXT. Sector concentration. The Canadian stock market is heavily weighted towards sectors like financials and energy. This means HXT's performance could be more volatile if these sectors face challenges. Counterparty risk. HXT's use of total return swaps introduces a small counterparty risk, which is the risk that the financial institution providing the swap might default. However, this risk is managed and minimized by regulations. Is HXT right for you? HXT is ideal for long-term investors looking for a low-cost way to invest in the Canadian market. It's particularly attractive if you're building a diversified portfolio and want to include broad Canadian exposure. Its low fees and tax efficiency make it a smart choice for those focused on maximizing growth over time.